and I'm going to take you through that. Then things to think about when buying a business out of administration or liquidation, which Tony's going to take us through. And then last but not least, how to keep lenders on side by Phil Bailey, who's our resident banking expert. And that was actually a little lie, because after that comes a Q&A. What I would say is that at 12:30 today, if you're within shooting distance of the centre of Norwich, we're running our Norwich Professional Network event at Bond in Tombland. So if you want to come join us and give us some feedback on how we've done at that, you're very welcome, even if you haven't already registered. So next slide, please. So yes, so just taking through a few bits and pieces. This is some proprietary data that we maintain, or at least the blue line is, which is East Anglia insolvencies, and we define East Anglia as Colchester and upwards. This is data going back to Q1 2008. That was at the end of a long boom and just before really the beginnings of the global financial crisis. And you can see the pattern of insolvencies. The red line is national corporate insolvencies. The blue line is East Anglian insolvencies. And don't worry, it's not a question that the majority of the national insolvencies are all in East Anglia. This is an index starting at 100. And then there's a black line, which is a bit of wizardry that we generate, which is businesses in distress in East Anglia. And that's defined as businesses filing accounts that are insolvent, basically. So what you can see is that in the global financial crisis, insolvency shot up. It then drifted down, down, deeper down, and then really, I suppose, tracked sideways. Then at the beginning of COVID, in the deepest recession for 300 years, corporate insolvencies roughly halved. This isn't totally showing that actually, but in some respects they did roughly halve, and that's down to all sorts of things, but really the government splashing cash. And then just recently, and this only goes up to the end of Q2, we've only just finished the end of Q3, haven't got that data yet. Corporate insolvencies are edging up again, but corporate insolvencies have been, I suppose the takeaway here is that corporate insolvencies have drifted down and tracked sideways since the global financial crisis, and they're still at extremely low levels. But you can see the yellow highlight area, which shows that there's a big disparity between businesses in distress and corporate insolvencies. And if this data is anywhere near right, at some point those lines are going to merge, because if businesses are in distress, they're either going to trade out of it or go bust, but they can't stay in distress forever without seeing some increase in insolvencies, is our thinking. Next slide, please. This is a slide of the recovery from previous recessions, and I think the takeaway here really is that each recovery has taken longer as we've had a recession and then a recovery from it, and to get back to the level that the economy was at when the recession started. And we will, and obviously there's been a very sharp recovery here in the UK following the COVID recession, although in fact this chart hasn't actually been updated for the very latest numbers, but I think the UK economy is about 3% smaller than it was pre-COVID. So we haven't fully recovered, but there has been a sharp recovery. So the takeaway here is that every recession, the recovery is different. Next slide, please. So no presentation like this would be complete without a disclaimer. And as lawyers, of course, you'll understand all about that. I should just point out that insolvency is not designed as a DIY process. If directors do get, if their business companies do get into difficulty, they should take advice. And if they don't, well, and indeed follow that advice. And if they don't, then they're likely to run foul of the insolvency service and potentially directors' disqualification. But what we say here is all subject to this disclaimer. So next slide, please. Hayley is going to take us through the insolvency update.
Thanks, Andrew. Morning, everyone. I'm Hayley Watson, a licensed insolvency practitioner and appointment taker at McTear, Williams & Wood. I'm going to take you through some of the changes that have been made to the insolvency legislation recently in 2015 and 2017. Next slide, please. So the way that IPs are appointed, how we're remunerated, and how we communicate with creditors all changed as a result of those changes. And then in lockdown 2020, the Corporate Insolvency and Governance Act came into force on the 26th of June, which was partly in a response to COVID, but also it had been consulted on since 2016. SIGA brings in a new moratorium, a new restructuring plan, a ban on termination of contracts in insolvency, and temporary COVID-19 provisions. And finally, the Finance Act 2020 came into effect on the 22nd of July 2020, which introduced joint liability for directors, and from the 1st of December reintroduced Hmrc as a secondary preferential creditor, both which will be game changers for most SMEs. Next slide, please. So from October 2015, the way that IPs can be remunerated changed. We used to get fee approval on a time cost basis and book and charge that time with no restrictions. However, from October 15, we now have to provide creditors with a fee estimate, which, if approved, acts as a cap on the remuneration that we can charge. It also introduced more flexibility, allowing remuneration to be approved on a number of bases, which includes fixed time, time costs, and percentage of realizations. Previously, it had to be one of the bases which you would then stick with. The overall aim was more disclosure, transparency, and engagement with creditors, but the reality is very different, with creditors swamped in pages of mostly unintelligible details and minimal contact. In April 2017, the new insolvency rules were introduced, which brought in decisions by deemed consent. This is where a decision like the appointment of an IP is made without a single creditor vote, unless over 10% of value of creditors object to the decision by the deadline, being 23:59 p.m. on the date of the decision. Creditors can also request a physical meeting be convened, and the rule of 10 will apply. That is 10% in value, 10% of the creditors, or 10 creditors. Decisions in insolvency processes can now also be held by deemed consent, by correspondence, electronic voting, or virtual meeting, and a physical meeting cannot be requested by creditors unless the rule of 10 is met. The legislation changed to increase creditor engagement in the process, which hasn't worked, and very rarely are physical meetings requested or creditors engaged in the process. In addition, the legislation has been made to changes to the way that IPs communicate with creditors, which can be given by notice to deliver reports on the firm's website, which has been adopted by most firms. In addition, small debts of £1,000 or less can be deemed as proved without creditors actually needing to submit a formal claim in the insolvency process. Next slide, please. SIGA, which came into effect, as I said, on 26th of June 2020, brought in the new Moratorium and Restructuring Plan. And we will be discussing how they work in our business rescue and insolvency options. But suffice to say, between the 26th of June and the 30th of June this year, only 5 companies have obtained a moratorium and 9 companies have had a restructuring plan registered at Companies House. That's because company rescue is rare outside of company voluntary arrangements, which mostly don't need the protection of a moratorium. In 21 years, we've only seen 2. However, we can see that a moratorium could be useful for small and medium-sized businesses if new investors or new finance is promised where time is required to get the deal over the line. It's also likely that large companies will use the moratorium in conjunction with the new restructuring plan. Next slide, please. So the restructuring plan is a variation on the existing scheme of arrangement and is similar to Chapter 11 in the USA, involving multiple court hearings. No one thinks it will be used by SMEs because it's complex and it's expensive compared to a company voluntary arrangement. In a restructuring plan, 75% by creditors in value in each class has to approve the plan. Next slide, please. However, a restructuring plan can bind secure creditors and the court can also impose the plan on any dissenting creditors, but they are only likely to do this where the plan gives the creditor class a better outcome than an alternative process. Virgin Atlantic was the first company to use it. Next slide, please. SIGA also introduced a ban on the use of termination clauses in insolvency, which extended the existing requirement to continue supplies by key suppliers like utilities and internet services, and extended this to all suppliers, and just as importantly, prevented them from amending contractual terms of pricing. We don't typically see this as an issue on many insolvencies, as trading insolvencies are very rare, and suppliers are generally more than happy to supply, knowing that they're contracting with a regulated professional. However, it will help post-appointment utility supplies where tariffs used to roughly double. And I think the most likely application where these will be used is in CVAs and trading insolvencies. Next slide, please. In addition, as a response to COVID-19, the temporary measures included a moratorium on statutory demands and petitions where the reason for non-payment was COVID-related. This was for the period 1st of March 2020 to the 30th of September 2021. Landlords are also prohibited from fulfilling leases, and that runs until the 25th of March next year. There was also a suspension on wrongful trading claims against directors between the period 1st of March 2020 to the 30th of April this year. And although wrongful trading is often raised with directors as a risk area, in practice it's an extremely difficult claim to pursue, and whilst it caught the headlines for all practical purposes, it was a bit of a non-event. Next slide, please. With much wider potential application and largely under the radar, the Finance Act 2020 introduced directors' joint liability for tax abuse, which took effect from the 22nd of July 2020. This places serial phoenixism firmly alongside tax evasion. A joint liability notice can be issued when 3 companies are subject to insolvency processes in a 5-year period, and the new company is carrying on the same or similar trade as at least 2 of the old companies. At least one of the old companies has a tax liability of more than £10,000 and was more than 50% of the total liabilities, and the relevant individual directors or shareholders are concerned in the management of the company. It covers unpaid and future taxes of the new company for 5 years from issue and unpaid taxes of the old company. The law is already in force, so the only way for directors to avoid a joint liability notice is to avoid insolvency altogether or to ensure that the debt owed to Hmrc does not become more than 50% of the total creditors. It remains to be seen how extensively Hmrc will use those powers to make directors liable, as it has more other powers that it rarely used, for example, to make directors responsible for NIC deductions. Next slide, please. The Finance Act also brought back the return of Hmrc as a preferential creditor, which took effect from the 1st of December. And like with the joint liability notice, this could be another game changer in our world as it winds back the clock to 2003. to make HMRC a preferential creditor, which could effectively leave little left for ordinary unsecured creditors. HMRC as a preferential creditor after the employees in respect of claims for arrears of wages and holiday, and it only covers taxes which are collected and held by businesses on behalf of other taxpayers. These include VAT, PAYE, employees NIC, and student loan and CIS deductions. It is likely to have far-reaching consequences, including fewer and smaller dividends to creditors in insolvency processes, a higher return back to HMRC, potentially less money to banks, more calls to directors under personal guarantees, and it may be the death knell for everyday CVAs, as dividends to unsecured creditors could be derisory. I'm now going to hand over to Tony, who's going to run through the business rescue and insolvency options.
Thank you, Ivy. My name is Tony Harrison. I'm an associate with McTear, Williams and Wood, and I'm going to take you through business rescue and insolvency options. For many of you, this will mostly be a refresher, but I will also be covering some of the new insolvency procedures. What I would say is we always exhaust the business rescue options before we get into the insolvency options. And what I'm about to do is run through those options in the order in which we consider each of them, which is in the order of least intervention. Next slide, please. So we don't have the rule of 6 anymore, but when we wrote this webinar, we did. Unfortunately, now it's gone, but there are actually still 6 options that we run through. And I ask you to think of these as a cascade where we rule in and out each one in turn. So if you can't trade on and out of difficulty without having to do deals with creditors, then we consider informal time to pay agreements, TTPs. If that's not enough, then we consider the new moratorium, then CVA, then finally administration and liquidation. Next slide, please. So prevention is better than cure. If a company can avoid having to break cover and compromise with creditors, then it should. It's not unusual for businesses to have to juggle cash flow for short periods, but not all of the time. And as a company becomes distressed, it usually happens slowly until towards the end when it becomes rapid and directors have to fight on multiple fronts. For example, when credit insurers withdraw. If the decline is not just about cash flow and revenue and costs need to be realigned, then cut early and hard so you start to see the benefits quickly. And don't be optimistic. Make sure forecasts are brutally realistic. Otherwise, you might pursue this option when another business rescue option is actually more appropriate. Next slide, please. Actually, that wasn't the next slide, but bear with me. So if cash flow is tight, prepare a rolling 12-week or short-term daily cash forecast so you understand the cash position throughout each month end. If your clients are thinking of introducing last chance funding, do so early. We have various ideas how, so do call us first. If the business is struggling, it is probably insolvent or near insolvent. If so, the director's duties change from acting in the interest of shareholders to acting in the interests of creditors. And to protect themselves, they should record decisions, take and follow professional advice. But case law has established that following professional advice gives directors a high level of protection. Well, I've now caught up with the slide. So if you can't trade on and out without doing deals with creditors, then you are going to have to enter into time to pay agreements. If a company cannot pay its debts when they fall due, then it is insolvent. But by doing a TTP, a company can become able to pay within agreed extended terms and so becomes solvent again. we expect in the post-COVID-19 area that creditors and lenders will be more receptive to rescheduling repayments. In particular, Hmrc, whose debts can build up very quickly and who will be under political pressure to be lenient. We are actually hearing that Hmrc is open to any reasonable offer. Ordinarily, Hmrc will not agree to extend time on tax that is already in arrears. Historically, TTPs over 3 months are a shoe-in. It is usually possible to agree payments over 6 months, but it is rare to see payments spread over more than 12 months. But include an initial payment on Hmrc's acceptance and keep to it. There is usually no second chance. Informal time to pay agreements with more than a few creditors are usually unworkable. Next slide, please. So if all informal TTPs won't work, then consider a formal moratorium using the new moratorium procedure. Once you have filed documents at Companies House, there can be no legal action against the company for 20 days. And this can be extended by creditors or the court for up to 12 months. It sounds great, but it can only be used when cash flow is so bad that the company is unable or near unable to pay its debts as they fall due, but not so bad that an IP thinks the company cannot be rescued or pay all its finance commitments and other credit incurred during the moratorium. We think those circumstances will be few and far between. Also, if the IP ceases to think that, then he or she has to bring the moratorium to an end. For SMEs, it is likely to be used in conjunction with the CVA or buy time to get a refinance deal over the line. Next slide, please. So if a moratorium won't work, then maybe a CVA could. CVAs were introduced in 2003 and got off to a slow start, but with the decline in the high street and now COVID-19, most national retailers, casual dinner businesses, etc., are either in or thinking about doing one, as they can be used to walk away from unprofitable outlets and reduce rents. CVA can be used if a company just needs time for something to happen, i.e. a contractual receipt, receive a contractual receipt, sell assets, refinance or win litigation, and that would enable creditors to be paid in full or in part. But more typically, to allow a company to restructure and make voluntary contributions over 5 years. It also can be used to wind down a business. However it is used, it is necessary to get 75% of value approval of creditors, and it needs to offer them something significantly better than administration or liquidation. Typically 30 pence to 40 pence in the pound, compared with a few pence in liquidation. A word of warning, most CVAs fail because most are based on voluntary contributions over a 5-year period when things do change. Next slide, please. If a CVA won't work, then maybe administration could. In 2003, administrations became mainstream when banks could no longer appoint administrative receivers under new debentures. The major advantage over liquidation is that administration creates a moratorium, stopping creditors from taking enforcement, which can assist to sell a business and assets as a going concern. Most administration appointments are made by a company's board of directors, but a lender with a floating charge has a 5-day window to veto the board's choice of IP and appoint their own choice. In 2003, no one had heard of Prepack Administration, but they quickly came to the fore, and even today, the majority of administrations are prepacks. And a prepack is where the sale of the business and assets is negotiated prior to the administration and completed soon after. Over the years, Prepacks got a bad name, seen as a cosy deal behind closed doors, and are increasingly regulated, so that today there has to be open marketing and detailed disclosure to creditors soon after the deal is done. And Prepacks have recently been the subject of further regulation by the government, so that all Prepacks from the 1st of April 2021 now have to be independently scrutinised. Administration hardly ever ends in company rescue, which is its primary statutory purpose, and is ended by the administrator moving the company to dissolution or liquidation. Next slide, please. If administration won't work, then that leaves liquidation. Liquidations followed the introduction of limited liability companies in 1844 and are used when a company has reached the end of the road. A solvent liquidation, known as a members' voluntary liquidation, or MVL, pays a surplus to shareholders tax at capital gains rather than income. An insolvent liquidation can be a creditor's voluntary liquidation, or CVL, initiated by the directors and approved by shareholders, or a compulsory liquidation by a court order. The latter process takes 2 or 3 months, is quite costly, and results in a civil servant known as the official receiver being appointed. Directors will always opt for CVL because it is quicker and they get to choose the IP. A run on case law in Europe and the UK has turned business rescue on its head. The Insolvency Act positions administration as a company or business rescue procedure, but case law has determined that TUPE applies to all administrator sales, so that all employees transfer to the purchaser. The same case law has determined that TUPE does not apply to business and asset sales by a liquidator. For most SMEs, whether employee liabilities transfer will make or break a sale as a going concern and jobs saved. Also, in a CVL, all the regulation around Prepacks does not apply. And if you follow the right procedure, a director's successor company can continue to use the same name. So whilst liquidation is the last insolvency option, it is definitely not the least. I'm going to hand over now to Amy again.
Thanks, Tony. So at McTear Williams & Wood, we have approximately 150 new insolvency appointments a year. And through those, we see all sorts of directors' conduct, some which are of course very good and some that are bad. And through that experience, we have identified the top 10 things that a director can do to avoid the worst pitfalls. Next slide, please. So the director needs to know the financial position of the business. As Tony mentioned earlier, to enable directors to be able to make informed decisions, directors need to know the company's current financial position. And exactly what information is required will vary depending on the size and complexity of the business, but at a minimum, they should have up-to-date management accounts and be able to see that they have enough cash flow for the foreseeable future. If the cash flow looks tight, we would always recommend that a 12-week rolling forecast is prepared. Directors should have a plan B and be realistic about it. They need to know where they want the business to go and should have integrated profit and loss, balance sheet and cash flow forecasts covering the year ahead. Those forecasts should be flexed so that at a minimum, directors have a base forecast that is achievable and a more ambitious forecast that can act as a target. We'd always recommend that professional advice is sought early. If the 12-week forecasts or the long-term forecast show that the business is running out of money, then they should seek professional advice and follow that advice. There is a case called the World of Leather where it was found that as the directors had taken and followed that professional advice, that they had acted properly. McTear Williams & Wood are happy to provide free advice to advisors on both named or unnamed bases. You shouldn't let the Crown debt get more than 12 months in arrears. Insolvency law requires that all creditors are treated equally, but the reality is often that Hmrc gets left behind. If the company is more than 12 months in arrears with its Hmrc debts, then this is a red flag that the Insolvency Services looks out for. and which could lead to a potential director's disqualification. As mentioned earlier, directors should also watch out for potential joint liability notices for repeated offences. We would recommend that directors have a written service agreement or contract of employment and be paid through the payroll or PAYE scheme, which can help justify their claim in an insolvency process. Next slide, please. Directors should stop drawing against any directors' loan accounts or paying dividends if the company doesn't have the distributable reserves to do so. They should also pay themselves a fair market salary. If the directors are planning to inject rescue funding into the business, they need to be smart about it, as this is risky and this could end up as an unsecured creditor. My colleague Phil is going to cover this in more detail later on. We would always recommend that they have a plan B, as that will speed up how quickly they can act if continuing to trade ceases to be an option. It will also help directors to understand their option and will aid current and future decision making. And finally, if the situation is getting them down, then it has gone too far. And this is a good test of whether the director should take specialist advice. There is almost certainly a better way. I'm now going to hand you over to Andrew.
So thank you, Hayley. So I'm going to cover how directors can avoid unlawful dividends and run into having what they regard as unexpected large director loan accounts, which we call DLAs. And this is the most common and the biggest problem for directors that we see. Sorry, next slide, please. And in over 300 or so open cases that we have, approaching 50% of those, there's an unexpected director's loan account or potential unlawful dividends that directors are having to answer for. So I'm going to explain in more detail things that your clients can do to avoid exactly that problem. Next slide, please. So I'm slightly repeating what Hayley's just been saying under top tips, but it is so important. So we do think that all directors should have written service agreements, and it's best if they are paid at least something and through PAYE whilst they're working in the company and not just rely on dividends. And the big thing there is that if they do have written service agreements or contracts of employment and are paid through PAYE, then they're accruing continuing service. And if it ever comes to a liquidation or administration or any other formal insolvency process, then they would be entitled to claim for redundancy and pay in lieu of notice any arrears of salary and holiday pay. And I'll just come on to a twist on that just a little later. So if for some reason they don't have a service agreement or contract of employment, are paid through PAYE, and then the company is getting into difficulties, and definitely if the balance sheet's got a minus number on the bottom of it, that would be a big red flag for that. Then they should certainly stop relying on payments by dividends and pay a market salary instead through payroll. And they should have a contract of employment or service agreement at that point, at the latest. As long as directors have at least 2 years service, they can claim redundancy. The current cap is £538 a year. That goes up every April. It's quite common. I mean, directors are usually the first employees of the company. So or quite often, obviously founding directors. Quite often they do have a lot of years of service. And so the £538 that the government pays out for every year of service for redundancy, and the same for pay and leave notice up to a maximum of 12 weeks, can soon mount, and it's quite common for directors to have claims into 5 figures. Next claim slide, please. Another thing to do, it's very common for directors to have a director's loan account, and it's in their interest really to keep that as low as possible. And so make sure that all expenses are claimed regularly and either posted to the DLA or paid. Don't leave them outstanding, and certainly not outstanding once an insolvency process has started. It's much better if it's all recorded in the company's books and records, and ideally contemporaneously. So the other thing to say is that DLAs are often reduced by dividends. Often those dividends are declared at the end of the year when the accountants finalize accounts and so forth. Quite often those dividends are actually interim dividends. So they're not formal end of year final dividends. They're just dividends sort of informally paid as approved by the board. In some cases, the board is only one director who's actually paying himself as the shareholder. And interim dividends actually have no status other than an intention to pay a dividend until they are either paid or posted in the accounts. And so we quite often see directors that say, oh, well, you know, this dividend was declared, but if it's not posted in the accounts before an insolvency process starts, it'll then be too late, and they will cop it and have to repay their director's loan account. So it's better if dividends are declared and posted regularly rather than leaving it, and that helps keep the DLA down. And as soon as a company gets into difficulty, stop paying dividends and pay a market salary. And that has another benefit, which is that if that salary is paid for over 12 weeks, so let's say the directors are paid a minimum salary at around the national insurance level, that's quite low, that's only about £8,000 a year, and we see that quite commonly. And then the company goes into a liquidation, they're only able to claim 8,000 divided by 50 weeks, which is well below the limit that the government will pay. So if they're paid a market salary, and for most directors, we would expect a market salary to be, you know, well over 30,000 for larger businesses, you know, several tens of thousands, then that would be above the level that the government paid claims at. And if they've been earning that higher salary for 12 weeks, that's the figure that their claims are processed at. So they get a sort of windfall benefit, and they don't run the risk of being paid unlawful dividends and having to repay them. And if directors have given personal guarantees, which is quite common, and they pay the personal guarantee, then that can be offset against the director's loan account, and it's not a question of copying it for the personal guarantee liabilities that the liabilities the company has, but are personally guaranteed. That is a small silver lining if there is a DLA at the end that the director's got to account for. But that deduction is only if the director pays it. If they don't pay it, then they cop it for the PG and they cop it for the DLA. Next slide, please. So I'm now going to hand over to Tony.
Thank you, Andrew. I'm going to run through our top tips when buying a business and assets from an IP, mostly from the point of view of a director looking to buy his or her insolvent company's business and assets back, because the majority of the business and asset sales done by IPs are back to a former director's new company. So next slide, please. So if a director is going to buy the business and back from an IP, they should want it to be in the best shape possible with its customers and supplier base intact. If the decision is left too late, customers and key employees will have gone to competitors. Also, if the decline of the old company becomes drawn out, the directors may have put all their personal savings into it to keep it going and therefore have nothing left to fund the new company. And of course, find themselves in breach of their director duties and face claims and director disqualification. As well as getting the timing right, directors need to choose their IP carefully because they need to be sure that they will be commercial, pragmatic and fair. Of course, directors, if directors have any trouble finding a good IP, we would be happy to point them in the right direction. Most business and asset sales by an IP have to be done quickly because otherwise, after a very short time, there will simply be no business left to sell. Think days, not months, that a corporate finance sale would take. So the successful purchaser needs to know what it wants to buy, how it is going to pay for it, and be able to put money on the table at completion. And that is just the start. They will need to have working capital ready and a clear plan for the new business. This all takes time, and the sooner those plans are started, the quicker the transaction will be able to move and the greater the likelihood of success. When buying a business and assets, the IP will give no warranties other than that he or she has been appointed and has the power to sell such right, title and interest as the company has in the business and assets. Caveat emptor applies, let the buyer beware. In the post-COVID-19 era, the time of insolvency appointment and business and asset sales is more critical than ever. If they can, we are seeing directors delaying that process while sales are well down because they don't want to saddle their new company with the overheads, although this runs a greater risk of breach of directors' duties. Other directors are looking to buy the assets and mothball the business, even although we're at the other side now, there are still some business that are still depressed. You may think of a travel agency running in the new no-go areas. Next slide, please. When you are negotiating with an IP, it is all about the art of the possible. You shouldn't make an offer you cannot deliver, but ideally you should ensure some cash is paid on completion, equivalent to the ex situ, so the auction value of the tangible assets, should be paying some premium over the ex situ value of the assets and or for goodwill. This varies a lot depending on the business, but typically this would be 50% above ex situ values. Negotiate to pay for stock or work in progress as it is used, or pay up front at a substantial discount, which can produce a super profit in year one. And one thing that often gets missed is to offer to collect in books, the book debts, for say a 15% commission of realizations, because you know the customers and you will be wanting to deal with them anyway. If buying the business assets, be wary of buying from an administrator. Insist on the insolvency process being a liquidation so that TUPE liabilities can be avoided. The employees like to be made redundant too, as they get a substantial payment from the redundancy payment service and their jobs back on the next day, usually on the same terms. Employee with 10 years service paid above or around the statutory limit would typically receive a sum over £13,000. Suppliers will be very wary. Don't expect credit for the first few months, and NewCo will have to provide sweeteners to secure future supplies, often paying a slight premium over list prices for a period. And most banks won't provide bank accounts or facilities to Phoenix companies that have purchased the business and assets from an insolvent company with the same directors. So do your research ahead. I'm now going to hand over to Phil.
Thank you very much, Tony. Good morning. My name is Phil Bailey. I joined McTear Williams & Wood last year, having completed a 28-year career in banking. In the last 10 years, I headed up a recoveries team, and for 5 years before that, I helped turn around cases and avoided them going to recoveries in the first place. So what I'm going to talk to you about is how to keep lenders on side and keep your clients on the right side with their banks. Next slide, please. As Tony mentioned before, and also Hayley mentioned, make sure you understand what is possible and what is not. Clients tend to overestimate and be overly optimistic about their current situations. So forecasting is very important. Don't exaggerate the situation. Work out the worst possible scenario first, and don't go to the bank unprepared. You may have your clients may have a friendly bank manager, but beware, they're not normally the ones that are sanctioning the agreement for extra monies. In terms of monies, as we mentioned before in this presentation, a lot of government support has been handed out in the last 18 months. How much? Well, for the East of England alone, according to the British Business Bank, £4.5 billion of bounce back loans have been advanced. That's £4.5 billion, and that is the East of England alone. And that's 149,000 loans out there. On top of that, CBILS is another 2.5 billion. These are the sort of larger loans to potentially larger companies. That's 10,000 of those have been handed out. So we are talking about £7 billion worth of government support. So with that backdrop, you can understand why lenders are somewhat cautious if clients approach them for additional monies at the moment, having had all that support. Also, this 7 billion has to be repaid. So companies are now starting to feel the pinch with those monies starting to be repaid. So don't be surprised if lenders are very cautious about advancing new monies. Make sure that, your clients are well prepared and coming to see us first, we can work out a plan. And as we've stressed before, turnaround is always the first option that we look at. There are a number of things that clients can do to prepare themselves and to help themselves with the bank. You must remember, this is not a normal negotiation between equal parties, so don't expect your clients to go in too high hoping for a smaller amount. All that will do is scare the bank, and they may put the client in special measures straight away because they're so concerned about the extra money as the client is requesting. Do make sure you underpromise and overdeliver. If you set yourselves milestones to get your overdraft repaid in a certain period of time, be brutally realistic and don't miss any milestones. Also, directors have a tendency to potentially bury their heads in the sand and not seek advice. So do encourage them to seek advice as early as possible. We will certainly give them as many options as possible and encourage them that there are other routes available. If you're going to the bank, present lots of scenarios so you can show that you've actually thought about the worst case scenario. And many clients will feel that once they've had the advice from us, that actually the worst case scenario is not as bleak. It does give them more confidence when negotiating with creditors. It may be that the clients have, directors have personal guarantees or maybe encouraged to enter these. These are very difficult to get out of once they're entered into, so they must think carefully before going down this route. They may want to inject new monies, and as Hayley mentioned earlier, putting monies into the business is a good idea, but there are smart ways of doing it. So if the directors are going to put their own money in, maybe they could consider buying an asset of the company so that they could sell that if the company goes bust at a later stage, then at least they can get their money out. Far too often we hear directors saying they wish they'd spoken to us previously, or shareholders, before putting money in. The banks like it when customers put monies in, and they don't really mind too much if they then say that they would like to purchase assets. The bank would rather see the company survive and cash get injected in. One of the other things is that during my recoveries phase, a lot of clients said that they wish they'd sought advice sooner, and also that they'd wish they'd actually decided to sell the business much earlier, because they're going through a lot of stress in the build up to it, and they don't really consider their options. So I think one of the important things when you're talking to a client is to make sure that they get advice early, and it's never too early to get advice. And all we're going to do at this stage is give them a lot of options, and avoid them, say, being one of those customers that said to me, you know, I wish we'd done this 2 years ago. And with that, I shall now hand back to Andrew.
Thank you, Phil. So we were aiming to get this done in an hour, and we've done it in 55 minutes. So we're about on schedule, just ahead. Are there any questions? If you use the Q&A tab at the bottom of your screens to let us have any questions. So just while you're thinking about that, oh, we have got some, beg your pardon. Blimey. Oh, that's interesting. Right, so you might be wondering if we're very busy in light of the global pandemic and all the supply chain problems that seem to be out there, and indeed have been very busy through COVID lockdowns and deep recessions, albeit there's been a sharp recovery. And the answer is, in general, corporate solvencies have roughly halved. I think they have drifted back a bit to pre-COVID levels. So we're perhaps about halfway from what we were seeing pre-COVID, but still well down on pre-COVID levels. And the other thing to say there, as you might recall from the corporate insolvencies chart I showed you at the beginning, is that sorry, I've lost my train of thought. So I'm looking for a question, guys. Anyone got a question? If not, one of my team might want to just add something. I think Tony was talking about the independent scrutiny of administration prepacks, which came in April this year, so it's quite current. And that is where an evaluator has to say whether the sale should happen or shouldn't happen. It doesn't actually stop the sale happening, but obviously, but that report from the evaluator has to be shared with the creditors. So it's obviously going to stir the pot a bit if the evaluator says it shouldn't be done and the sale still goes ahead. But actually, that is only for pre-pack sales. Well, what we would call Phoenix pre-pack sales. So that is pre-pack administration pre-pack sales back to a former director or manager of the company. So that is not pre-pack sales to third-party purchases. So, although, as Tony said, most pre-pack sales are back to former managers. So I don't think I'm seeing, unless I'm missing it, I don't think I'm seeing any questions. And it's very good of you all to stay on. I see all 12 of you are still there. So thank you for sharing or being our audience here. And if you haven't got any questions, we can bring this to an end within the hour. And for those of you who are near enough and have time available, hopefully we'll see you at the professional networking event at Bond at Tombland in about half an hour's time. So thank you for attending, and we'll bring this presentation to an end now.